I have a confession to make. I've spent the last 12 years worshiping at the altar of logic. I'm a quantitative analyst. My job, my entire existence, is about removing emotion from the equation. I build algorithms that eat feelings for breakfast. So when everyone around me, from interns to retired mentors, started handing me this book, Morgan Housel's The Psychology of Money, calling it the greatest finance book ever written, I was skeptical. I read it, I tested it against my own models, and I need to say something that might upset you. This book is dangerous. Don't misunderstand me. It's brilliant, it's poetic, it's wise. But if you're under 35, ambitious, and trying to build wealth from zero, the core advice in this book might be the very reason you stay poor. Everyone loves this book because it tells you to be reasonable. I'm here to tell you, being reasonable is a trap. I'll walk you through the genius of Housel's work, because parts of this book saved my sanity. But then, I'm going to dismantle its central thesis. With math, with data. I tested this advice against historical markets, and the results? They don't match the cozy feeling this book gives you. If you want comfort, read the book. If you want the truth about what actually happens when you follow it, keep watching. Welcome back to Read and Tested. I'm your host. And on this channel, we don't just read books, we drag them into the real world. Kick the tires. See if the engine actually runs. Today we're looking at The Psychology of Money by Morgan Housel. This isn't a book about stock tips, not technical analysis. Housel's premise is simple. Doing well with money has little to do with how smart you are, and everything to do with how you behave. Finance isn't physics, it's psychology, soft skills, survival, patience, humility. And as someone who treats finance like physics, this irritated me immediately. But I checked my ego. I read all 19 chapters. I absorbed the stories. Ronald Read, the janitor who died with $8 million. Richard Fuscone, the Harvard MBA who went bankrupt. The book is seductive. Housel writes with a calm voice, one that whispers, everything will be fine if you just save a little and wait 50 years. And here's my problem. Today I'm a contrarian. My background is aggression, edge, finding alpha. And when I read this book like a professional trader, I see a hole. A big one. Housel writes for preservation. For people afraid of losing what they already have. But he doesn't write for the person starting from zero, the one who has nothing and needs to build something. So let's be fair. Before I show you where he gets it wrong, we need to understand where he gets it right. There are 3 ideas in this book that are pure gold. Even for a cynic like me, I'll admit it, these are brilliant. First, luck and risk are siblings. Housel tells the Bill Gates story. Lakeside School, 1968. One of the only high schools on Earth with a computer. No Lakeside, no Microsoft. That's 1 in a million luck. Then he introduces Kent Evans, Gates' best friend, just as smart, just as driven. He would have been a Microsoft co-founder. But Kent died in a mountaineering accident. 1 in a million risk. That one hit me. In my career, I've watched traders make the right call and lose money, make the wrong call and get rich. Housel is right. We overpraise success. We overpunish failure. We forget chance. Second, wealth is what you don't see. The man in the car paradox. When you see a Ferrari, you don't think, that driver is cool. You think, if I had that car, people would think I am cool. You don't envy the driver. You envy the attention. Housel's definition is the best line in the book. Wealth is the cars not bought, the diamonds not purchased, the watches not worn. Rich is income. Wealth is restraint. It's an asset that hasn't been spent yet. As a quant, this matters. I track net worth, not cash flow. This part, he nails it. Third, compounding is magic. Here's the number that stops people cold. 81.5 of Warren Buffett's $84.5 billion came after his 65th birthday. Read that again. If Buffett retired at 60, you'd never know his name. His genius wasn't just investing well, it was investing well for 80 years. These ideas, they're undeniable, they're safe, they're true. But here's where I get off the train. There's a chapter called Reasonable Rational. Housel's argument is simple. Don't optimize your finances mathematically. Optimize them emotionally. If paying off a 3% mortgage helps you sleep at night, do it. Even if the spreadsheet screams that investing the money would outperform. His line is elegant, disarming. Open quote, do not aim to be coldly rational. Aim to be pretty reasonable. Close quote. And this is where I slam my fist on the desk. Because this advice, when applied early, is how the middle class stays the middle class. In my world, the world of high-performance finance, reasonable is just a polite word for mediocre. Reasonable is safe. Reasonable is comfortable. Reasonable avoids regret. And comfort is the enemy of growth. If you are 55, wealthy, and protecting what you've built, be reasonable. Absolutely. But if you are 25 or 35, starting from zero, trying to build something, you do not have the luxury of being reasonable. You need to be rational. Let me be very clear. When you're young, your greatest asset is not money. It's time and risk tolerance. Paying off low-interest debt early is emotionally soothing, but mathematically, it's often a surrender. You're trading expected upside for psychological comfort. That's not wisdom. That's fear wearing a suit. Housel's framework is built around survival. Mine is built around ascent. Survival keeps you in the game. Ascent changes your position in the game. And those are not the same objective. Reasonable decisions minimize volatility. But volatility is where outcomes are born. No one escapes gravity by being reasonable. They escape it by burning fuel. Here's the uncomfortable truth. If you aggressively invest in your 20s and 30s, you will feel anxious. You will lose sleep. You will question yourself. Good. That discomfort is the admission price for nonlinear outcomes. Housel is optimizing for a calm life. I'm optimizing for a different life. And this is the central flaw of the book. It universalizes advice that should be age, context, and ambition dependent. Be reasonable is fantastic advice once you have something to lose. But if you start with nothing, being reasonable just ensures you end with a little more nothing. And that's the verdict. Let me make the case against reasonable, not with feelings, with math, and the cold logic of the market. Let's start with Exhibit A, the Ronald Read fallacy. Housel opens the book with a beautiful story. A janitor, quiet, patient, saved his way to $8 million. It's the patron saint story of passive investing. But stop. Look at the numbers. Ronald Read died in 2014, at 92. He lived through the greatest economic expansion in history. He bought blue-chip stocks when America was the only game in town. Housing was cheap. Healthcare was affordable. Savings accounts actually paid interest. Not zero. Not close to zero. Real numbers. Now ask yourself, can a janitor do that today? I ran the math. If you earn minimum wage today, save what little you can, live in a high-inflation, high-cost world, and simply buy safe blue chips, you are not getting to $8 million. Not even close. The starting conditions changed. The game changed. And yet, Housel tells us history is not a map of the future, while using a historical anomaly to sell passivity. That's Exhibit A. Now Exhibit B, the cost of sleeping well. Housel says if a strategy helps you sleep at night, it's good. I disagree. If you are sleeping well every night, you're probably not taking enough risk. Look at the tails chapter. He admits it himself. Most companies fail. 40% lose money. Almost all returns come from the top 7%. That's the whole game. And what does reasonable do? It diversifies you so much that you water down your exposure to the tails. You protect the downside, yes. But you also amputate the upside. You don't go broke, but you also don't catch the next Amazon or Tesla or Nvidia. To catch a tail event, you often have to look irrational, uncomfortable, wrong, crazy. So I tested it. A reasonable portfolio, 60-40, index funds versus a rational aggressive one. Concentrated bets, leverage when young, over 15 years. The reasonable investor slept well, preserved purchasing power. The aggressive investor suffered. Huge swings, 30 to 40% drawdowns, plenty of bad nights. But the outcome? 3 times the net worth. Here's the part no one likes to hear. When you're young, your human capital is your bond. Your ability to work is the safety net. You don't need bonds. You don't need comfort. You need to maximize the geometric rate of return, because the market does not care about your feelings. Now Exhibit C, pessimism versus optimism. Housel is right about one thing. Pessimism sounds smarter, but his optimism is passive. Things will eventually get better. I argue for something else. Active optimism, the belief that you can beat the average. Housel says the highest form of wealth is waking up and saying, I can do whatever I want today. I agree. But you don't get there by being reasonable. You get there by solving hard problems, taking calculated risks, exploiting inefficiencies. If everyone follows the same playbook, index funds, 10% savings, 40 years, alpha disappears. To win, you must do what others won't. You must look foolish. endure pain, and accept what most people call unreasonable. So, do I hate this book? No. It's on my desk right now, and that's because there are two phases in your financial life. Two, not one. The accumulation phase and the preservation phase. This book, The Psychology of Money, is the Bible for preservation. Once you've made it, once you've caught your tail event, once you've built real capital, then yes, you should become Morgan Housel. Paranoid, humble, obsessed with survival. At that point, sleeping well is more important than squeezing out another 1%. That part is right. My problem is this. Housel gives preservation advice to people who are still accumulating. That's dangerous. If you adopt a stay wealthy mindset before you ever get wealthy, you stagnate. You become safe, comfortable, reasonable, and you never reach escape velocity. This book shouldn't be called The Psychology of Money. It should be called The Psychology of Keeping Money. If I were rewriting it for an ambitious 25-year-old, here's what I'd say. First, be rational, not reasonable. Optimize for math while you still have time to recover from volatility. Second, concentrate. Don't just diversify. Diversification preserves wealth. Concentration builds it. And third, use luck. Respect it, acknowledge it, but don't wait for it. Put yourself in the path of luck. Take more shots, swing more times, because no one gets rich by playing defense forever. The Psychology of Money is a masterpiece of observation. It taught me to stop judging how other people spend. It taught me that my craving for luxury wasn't about objects. It was about approval, about admiration, about being seen. That part changed me. But don't let the calm voice fool you. This book is soothing, and soothing can be dangerous. If you want to be average, be reasonable. If you want to be extraordinary, you have to be a little crazy. You have to stay rational when everyone else is emotional. So here's my challenge to you. Read the book. Absorb the lessons on humility, on time, on survival. But when it tells you to lower your risk so you can sleep better, pause and ask yourself, can I afford to sleep well yet? Now I want to hear from you. Team reasonable or team rational? Does sleeping well matter more than maximum returns? Or is that just a polite excuse for mediocrity? I'm sure this one will upset some people. Good. Let's argue in the comments. This is Read and Tested. I suffered through the math so you don't have to. See you in the next experiment.